Welcome back to The Explainer. I am so incredibly pumped you're joining us today because we're laying down the absolute bedrock of modern finance. Consider this explainer the indispensable scaffolding. We are constructing the mathematical foundations of fixed income, step by step. And trust me, you really need this scaffolding securely in place, because without it, the complex yield curve arbitrage strategies we're going to tackle in Explainer 10 will look like pure magic. Today, we're turning that magic into math.
Okay, let's dive into this. Here is our roadmap. 1. Zero coupon bonds. 2. Fixed coupon bonds. 3. Floaters and swaps. 4. First-order risk. And 5. Second-order risk.
Section 1. Zero coupon bonds. The atom of finance.
So, to understand massive, complex financial structures, we really need to first isolate the fundamental building block. And honestly, it's kind of fascinating how simple this foundational concept actually is. A zero-coupon discount bond is literally just a promise. It's a promise to pay exactly one single dollar at a future maturity date, which we'll just call T. And that's it. No intermediate payments, no complex terms, just a single dollar in the future, sitting there with a specific price today.
Now, because you're buying that future dollar at a discount today, we obviously need a way to measure your return. And yeah, this math for the yield under continuous compounding looks a bit rigorous, but let's just translate it into plain English. This formula simply measures the average interest rate over the period from today, time t, all the way to maturity t. The natural log you see there, that just smoothly handles the continuous compounding of that return over time. Nothing to be scared of.
But this brings us to an absolutely unbreakable rule of gravity in fixed income. Seriously, if you memorize just one thing today, make it this. The higher the bond price today, the lower the yield. And vice versa. It makes sense, right? Because that future dollar is fixed. If you pay more for it today, your return, your yield, just has to be smaller. This inverse price-yield relationship, it literally drives everything that follows.
Section 2. Fixed coupon bonds. Stacking the bricks into molecules. Okay, now that we understand the atom, let's start stacking them together to build something a bit bigger. And hey, please don't let this equation intimidate you. We can break it down together. The price of a coupon bond is literally just adding up the present values of all its parts. That first part is simply our atom from before, the present value of the final $1 principal. And that second part? It's just a summation of all the individual coupon payments you receive along the way. You're basically just stacking atoms together to find the total present value. That's the whole shebang.
So, what if we want this brand new bond molecule to start exactly at its face value of $1 today? Well, this formula gives us the par yield. It tells us the precise required coupon rate, which is represented by K, that we absolutely must demand from the market so that the present value of all those future cash flows equals exactly $1 right now.
Which brings us to Section 3, Floaters and Swaps, Building Financial Machines.
All right, moving from static molecules to dynamic financial machines, we have the floater. See, a floating rate bond resets its coupon payments periodically based on a benchmark index, something like LIBOR or SOFR. And this formula shows us exactly how that reset works. The actual coupon payment you receive represents the exact interest you'd earn if you took a single dollar and bought a zero coupon bond at the previous reset date. So it's constantly updating itself to reflect the current cost of money. I know it kind of feels like a Wall Street magic trick, but a standard floater is always worth exactly par. $1 at issuance and on every single reset date. You might be wondering, why is that? Well, it's because holding a floater is mathematically identical to a sequence of trades where you invest a dollar, collect the market interest at the reset date, and then reinvest that exact dollar over and over again until maturity.
And this brilliantly illustrates the foundation of an interest rate swap. Imagine you've got side A, a super predictable fixed coupon bond, but, you're scared rates are going to go up. Meanwhile, your counterparty has side B, a variable floater, but they want predictable fixed payments. An interest rate swap is simply the mechanism of exchanging side A for side B. You're quite literally swapping the cash flows of a fixed bond for a floating bond. It's a perfect trade-off.
Now, to make this swap completely fair at the very beginning, meaning it has a zero present value and costs exactly nothing to enter, we have to derive the par swap rate. So we price the fixed leg, we price the floating leg, and then we just set them equal to each other. The resulting fixed rate K ensures we have perfectly balanced scales on day one.
Let's shift gears. Section 4, First-Order Risk, Duration, the Physics of Finance.
Okay, I want you to really pin this next concept in your mind, because this is where we introduce the actual physics of how these structures handle market stress.
We measure a bond's timeline using Macaulay duration, but try not to think about this as just a ticking clock. Think of it more like a center of gravity. Macaulay duration calculates the weighted average maturity of all the bond's incoming cash flows. You're weighing each future payment by its present value. So the bulkier those early coupons are, the shorter your duration gravity pulls.
So while Macaulay gives us a time metric, modified duration gives us a risk metric. Look at that partial derivative there. Let's just translate it into plain English. It simply measures how fast the bond price changes when the interest rate moves a tiny, microscopic bit. It's your first-order sensitivity. And dollar duration? That just scales that percentage into hard cash, showing you the absolute dollar impact on your portfolio.
So you really should visualize duration as a long, rigid lever. If interest rates move just a little bit, this rigid lever predicts your price changes with beautiful, pinpoint accuracy. But here's the catch. Because it's a straight line trying to measure a curved reality, it assumes perfect parallel shifts. So under extreme market pressure, this rigid lever, it starts to bend.
Which brings us to probably the most dangerous question in fixed income. What actually happens to our rigid duration lever when the market experiences a massive sudden shock? I mean, what happens when rates jump 100 or 200 basis points literally overnight? Well, our straight line completely fails us.
And that brings us to Section 5, Second-Order Risk, Convexity, the shock absorber.
That failure under extreme pressure is exactly why we desperately need a shock absorber. And here's the math behind it. Yes, it's a second derivative, and yeah, I know it looks a bit intimidating, but it is the absolute load-bearing mathematical foundation for surviving large market shifts. It measures the nonlinear curvature of the price-yield relationship. Basically, it tells you how much your duration itself changes as yields move around. So the crucial point here is how these two forces actually work together to protect you. This slide right here shows the second-order Taylor expansion. To find your actual price change during a market shock, you first calculate the straight-line drop using your first-order duration. Then you add back the second-order convexity adjustment. Convexity literally bends the math back in your favor during massive rate swings. It's kind of amazing. And why is this so highly prized by traders? Well, it's because standard long-duration fixed coupon bonds typically possess positive convexity, meaning as rates fall, your bond prices rise faster than duration predicts, and as rates rise, your bond prices fall slower than duration predicts. It is, for sure, the ultimate structural safety net for your fixed income portfolio.
And with that, our scaffolding is fully in place. You now understand the atomic zero coupon bond, how they build floaters and swaps, and the vital physics of duration and convexity. You are officially mathematically armed and ready. Because without this scaffolding, the advanced yield curve trades coming up next would just look like pure magic.
But I'm going to leave you with this provocative thought to chew on. We know convexity perfectly absorbs massive parallel rate shocks, when all rates move together. But what happens when short-term rates skyrocket while long-term rates just plummet? How do we price the risk of the yield curve twisting entirely out of shape? Well, that, my friends, is exactly what we'll be mastering in Explainer 10. Stay curious, keep learning, and I'll see you in the next one.